I have a super quick announcement before we jump into your regularly scheduled pod, but want to promote this webinar that Jeff Cohn, co-host of the pod, as you well know, CIO, Chartered Financial Analyst, is hosting a live webinar Thursday, December 12th at 12:30 p.m. Eastern Time. If you want to get access to the webinar, you can follow us on Instagram or Facebook. Instagram is beam_wealth_advisors. Facebook, just Beam Wealth Advisors. And we'll be going live at 12:30 p.m. Eastern Time. Jeff's going to be talking about the insights on the market, economy, and answering your most pressing financial questions in real time. Make sure to tune in. Will be an awesome webinar. Now to the show. All right, Jeff, we are recording here about a week removed from the election. We're here on November 12th. How's it going for you? I know the markets have been ripping here recently, so it's always love to see that. But
it's a great time to own assets. That's all I can say.
Oh, yeah.
Basically every asset that you can own has gone up over the last few months and over the last week since the election. That's been the case as well, unless it's essentially long-dated treasury bonds. That's it. But we own a lot of other stuff too that went way up. So I'm happy to share some of those results with you.
For sure. We'll definitely dive pretty deep into all of that here in just a sec. But for the icebreaker, I have something that's super passionate to me. Jeff, when is the appropriate time to put up Christmas lights? And when is too early?
A lot of people really like Christmas so much that they like to celebrate all year long. And so they like to keep Christmas lights up all year long. I'm totally okay with that, right? This is a free country. If people want to put up the lights, I think the lights look great at night. I love looking at them. I say if it's Christmas lights all year round, if it's the Christmas tree, you got to wait till after Thanksgiving, right? After Black Friday for like the Christmas tree, the Santa Claus, the nativity sets. But like lights up on your house or like around your house on your porch or your deck or something like that, I'm totally okay with that being a year-round thing.
The outdoor lights for sure. I get that. I'd agree. I feel like it's weird if you have it on like a bush or a tree pre-Thanksgiving, but I saw some Christmas lights. What would be like
your HOA like guidelines for Christmas lights?
If it's before Halloween, immediate eviction. I think there's no ifs, ands, or buts.
Okay, that's not going to fly in California, but all right.
Before Thanksgiving, there's the talking to. And then after Thanksgiving is mandatory, A
talking to, like you show up on like the Ring doorbell and be like, hey, this is an infraction. I'm going to fine you. If that's what you think, man, that's cool. But I think in general, like Christmas decorations are the best looking decorations, right? You think of like Halloween decorations and I'm seeing like all these like random like demons like swinging from people, like the top of people's trees and like all these coffins in their yards and stuff. Like that's one thing, all the pumpkins and like some of the Thanksgiving decorations with a turkey, like, all right. But Christmas lights, it's all like snowmen and lights and stars and all this stuff. Like it's just much better. It makes people happy seeing it. So I'm okay year round. I'm sticking with it.
All right. I like it. I'm obviously being over exaggerating, but
wanting to evict somebody is exaggerating for the Christmas lights before October. Dude's a Scrooge.
At least it's not jail. Jail would have been my preference, but as you asked if I was HOA, I don't have that ability. But
that's definitely what the HOA people would be doing.
We have an awesome episode, but let's roll into it.
Hello, and welcome to Map Your Money, a finance-focused podcast. We exist to simplify the lives of our clients and listeners and help individuals create the roadmap for their financial future. Content is for educational purposes only. Consult a financial advisor or conduct your own due diligence of investing. Calls are pre-screened and the content was pre-recorded.
All right, Jeff. So what do you have for us? I know going forward, we're kind of switching it up, and you're taking one investment management, economy sort of topic, and then I'm going to do a financial planning topic. But I'll leave the reins to you. I know there's been a lot that's happened since the election. Again, we're recording here on November 12th. This episode is probably going to come out towards the end of the month, but important to keep that context in mind as well.
Yeah, happy to talk about it. I think first, before we start, I would like to give a shout out to all the veterans out there that listen to our podcast. Yesterday was was Veterans Day on November 11th. My father, I have two great uncles, my brother, a lot of people in my family served in the military, both overseas and at home. So I would like to have a shout out to all of our veterans out there. So as we talk about the election and some of the market reaction to the election, it's been pretty crazy. Leading up to the election, a lot of people were asking me like, hey, kind of what is the market's like general sense? Who's going to win here? And the general consensus of the market is, if you look at the way the market was the price action leading up to the election, you saw interest rates, especially on the long end of the yield curve, moving up. You saw stocks moving higher with small caps leading. You saw a lot of cyclical areas of the stock market, such as banks and transports and materials, industrials. All those parts of the market were leading as well. And so a lot of people were understanding that to be a bit of a Trump trade, right? Expecting that Trump was going to win. We also saw cryptocurrencies do really well leading up to the election. So people thought, okay, looks like a Trump victory is kind of priced in. I was thinking that too until Wednesday morning, when we saw the price reaction after Trump's victory, right? And the price reaction was, markets were up across the board, really, really strong performance, 1% to 2% on that day. We had a lot of cyclical stocks outperforming, crypto stocks or cryptocurrencies, and some of the related equities were up, double digits, right? So this kind of had me thinking, okay, maybe this wasn't as priced in as we thought. Yeah. And this was actually a bit, surprising to the market. So, I would kind of like to go through. I have some graphs here that I can show you that I've gotten from Y Charts. And the first one that I would like to show here is really just looking at the 1 year performance of equity indices for the past year. And then I've put like a bit of a purple vertical line on election day to show you kind of the gap higher in prices. And I think one thing that I would point out about this chart is that equity prices were doing really well all year leading up to the election. We've had a really good year of markets in 2024. We had a really great year in 2023, and we've seen that really continue. But then as the election hits, you can see that everything, really across the board. I'm looking at Russell 2000, small caps. I'm looking at mid caps, S&P 500, NASDAQ, and the Russell 1000 value all have really good performance after election day. And I am looking 1 year out. If you look at what's outperformed, it's actually the Russell 2000, so small caps. And then that's right behind that is the NASDAQ. And then, of course, you see, mid caps and the S&P also trailing that a little bit. So what we've noticed is that, hey, maybe the markets hadn't fully priced that in, but the markets certainly liked that result. And that is, we'll certainly take it as owners of assets.
Yeah, certainly. And I know this is something that we'd been saying for a while, kind of coming into the election, is that the markets don't like uncertainty. We talked about that when we saw that pullback back in August. And once the election is concluded, you kind of have that certainty and know what you're getting going forward, whether it was kind of what was best for the economy or not best for the economy, aside the point, like you have that additional certainty. And then clearly, markets are pricing this in as kind of a good thing for stocks going forward. But I guess you kind of have this graph here. We'll show it again on the YouTube. But we see this huge spike in kind of all these asset classes right after election day. Is this something that we've seen in prior elections or you're used to? Is this kind of like a unique thing that we're seeing here based off of this last election?
Yeah, so I'll tackle this a couple of ways. So I think it's interesting, since Trump was reelected, to look at what happened after he was elected for the first time in late 2016 and look at the market reaction then. So I went back and I did that. A couple of, I think, interesting notes here. The number one is small caps, banks, and the cyclical sectors such as transports, industrials, et cetera. They all outperformed in 2016, 1 month, 3 months, 6 months, and 1 year after the election. So that's very similar to what we're seeing now is, small caps outperforming, industrials, transports outperforming. That's very consistent with what we saw back in 2016. After a full year, after 2016, we look at just like the 1 year returns. The NASDAQ was the best performer, up 32%. The S&P was up 24%, and the Russell 2000 was up over 25%. So a really strong year. Something else after 2016 was that going into 2017, we had, as you're saying, a lot less uncertainty. There was a lot of, I think, positive sentiment after the Trump win. I think psychologically, a lot of people, that kind of ignited something in them to become more optimistic about the economy. And 2017 ended up being a really great year for stock returns. Not only was the S&P up over 20% that year, but the VIX averaged 11.1 during that period, which is an abnormally low level for the VIX. Lately, it's been trading around 15. Before the election, it was 21. So a level of 11 throughout 2017 was very impressive, and it really shows how strong an environment that was and how confident investors were during that period. I would caution, though, that after 2017, we get into February 2018, which was the Volmageddon meltdown. And so, sometimes these periods...
What do you mean by Volmageddon?
So Volmageddon was when volatility as measured by the VIX and equity markets was so low and was trending lower because nobody needed insurance protection against the market. Nobody was buying puts. And so you had all these strategies come out that were shorting the VIX, betting that the volatility would stay low and the VIX would continue to go lower. And this is essentially just clipping a small coupon and taking the risk that there could be a sudden sharp spike in volatility, right? So you're kind of betting that there's not going to be some kind of huge event in the market. Guess what happened, right? There was a huge event in the market. The VIX spiked, and a lot of these exchange traded products that were, short the VIX or double or triple X short the VIX went to zero. And it created a lot of kind of knock-on volatility, kind of like what we saw with the in-carry trade in August that you mentioned.
Yeah.
So I think, that's something to think. I'm not saying that that's going to happen, in 2026 or by any means. And certainly if history is a guide, the year after Trump's first election was a really good year in 2017. Maybe that's what we get in 2025. I think growth is going to be strong in 2025 for a lot of reasons.
Sure.
But so far, we're following that same playbook.
Is there anything you could point to policy-wise that you think under a Trump administration, as well as the Senate being red, and I think the House is still counting last I checked, but it looks like it's trending red?
I think the House is still counting. Looks like the House is going to be pretty close last I've seen. So I think, in general, the Biden administration has been pretty hostile toward M&A, so mergers and acquisitions, and the ability of companies to consolidate, which really does have a lot of good, efficient outcomes, within capital markets when this happens. I mean, it's good for companies to consolidate assets. Their cost structure becomes more efficient. They have more economies of scale, so they can offer lower prices to their customers. I mean, a lot of companies weren't able to do this under the Biden administration because of the FTC chair, Lena Khan, and how much she blocked mergers. So it's understood that that's going to be easier. Republicans generally give a more friendly business environment. I think there's some on the left that think maybe it's too friendly toward business, right? But in general, I think open markets, open competitive markets are really efficient at allocating resources. And so I think that gives a lot of people confidence in the Trump presidency, as well as M&A returning, capital markets being back open, which is maybe why we're seeing such a big pop in small caps. Small caps typically trade at a premium to large caps because of that, let's call it a takeover premium, right? So kind of understood that small caps are typically targets for takeovers. That premium really has gone away over the last few years. We've talked about that many times here, how cheap small caps are relative to large caps. A lot of small cap PMs I talk to think that premium is going to return to small caps because the M&A market is back open. So I would say that's just one example, right? Another example is Republicans have full control of the government. And right now we have pretty wide fiscal deficits. I have a slide on this. I think it's, 4 or 5% of GDP right now. That's about right. About 6% of GDP, which is really high. This was expected to continue under both administrations, but with a full red government, Republicans will have the ability to pass more spending packages, or put another way, really the Republican way is not really increasing spending, but lowering taxes. And that increases fiscal deficits a little more. You have Trump tax cuts, which are set to expire in 2027, I believe. And I think Trump is going to try to extend those. And so there's generally a sense that fiscal deficits and the stimulus that creates in the economy will more than likely continue under a Trump presidency, especially if he has, Republicans have control of Senate and the House.
Yeah, and that's something I want to kind of dive a little bit deeper in, because I feel like I definitely have a better understanding of the economy than a lay investor. But once it comes to our debt and the deficit, and anytime that conversation comes up at a dinner table, I kind of shy away, just because I'm like, we just the deficit keeps increasing. Our debt number keeps increasing. I know we've touched on it in the past, but you want to kind of explain that a little bit more and what that really means for our overall economy in the short term, and then maybe like even longer term, at what point is there a sticking point on, okay, something needs to change? Because I feel like that's what everyone's opinion is that we can't have it like this forever. And where do we go from here? Or when does that change need to happen?
Yeah, so let's define what a government fiscal deficit is. This is the difference between what the government brings in tax payments and what the government spends within its expenditure, right? Within its budget, it usually spends much more than it takes in taxes, so it has a fiscal deficit. So not too long ago, I was in Boston at an investment forum for RIAs, and I asked one of the panels that was two founders of a lobbyist firm, and I asked them, what do politicians really think of the debt and the deficit? And they kind of chuckled, right? They kind of like elbowing each other, like, this guy, like he doesn't know. And they told me, they said straight up, like they don't care, right? It's all just a public ruse. You've seen under both administrations that neither one of them is willing to really tackle the issue, right? Really what they just use it as kind of a crux for whenever the other one is in power to kind of levy a lot of this blame and the blame game. And so with those out of the way, let's get down into kind of like the brass tacks of it, right? So the reason why, and I have like a different slide in my reference sheet here. So the reason why the fiscal deficit is so large is because we spend so much money on Social Security, on Medicare, on Medicaid, on defense, and now on interest. If you take all of these components of the budget, these essentially are things that politicians are unable to change as far as like interest on our debt goes, or unwilling to change because it's political suicide, right? So they're not going to lower the defense spending. They're not going to cut back on people's Social Security. They're not going to take away Medicare. And these really are the issues that need to be addressed, right? If you take away all of those things and you look at the spending that we spend on literally everything else in the budget, I think I'm getting my numbers maybe, I think they're pretty close here. I think it's like $1.8 trillion, right? That we spend on everything else. Well, our deficit, I kid you not, is about 1.9 trillion. So if we literally cut everything else in the budget except those things that we know are politically unpopular or impossible to cut, we still would have a government deficit. And we're talking about, spending for infrastructure, for roads, spending on, federal departments. How about FEMA and some of the hurricanes that have happened over the last few weeks, and how people have talked about the kind of aid that's necessary in those situations? If you cut all of that to zero, we still have a fiscal deficit. And so I think the problem is that you either need to raise taxes or dramatically cut spending in some of these programs. And the true answer is that you have to do both. And, so I think somebody wise says there's never solutions, only trade-offs. And sometimes voters are not willing to accept trade-offs. They want both. They want their cake and they want to eat it too. So they want a balanced budget, but they don't want lower Social Security. They don't want lower Medicare, and they certainly don't want higher taxes.
So, I mean, you mentioned those big sticking points of things that Social Security, Medicare, all these things that any politician either side comes in, and if they completely slash it or change it, it's political suicide. And whether you're Democratic, Republican, whatever it might be, I think everyone can agree that one of their most important mandates is staying in office. And I think it's very rare, or I'd be surprised to really see that. I know that's something I talk about with clients when it comes to Social Security and that being underfunded. But I guess at what point does it become, okay, this is urgent? Because I feel like this has been a talking point for the last 2 decades, if not more.
Yeah, so the problem with that is that no one knows, right? Here's what everyone can agree on. There's 2 things everyone can agree on. It hasn't mattered yet. All right, fine. It will matter eventually. Okay, great. We're all on board. Okay, but when? We don't know. I think there were some studies done. There's a lot of empirical studies done on this. They look at the debt to the GDP ratio, because it's kind of thing about like, all right, like measure the total country's debt that they have versus how much production and income there is in a total economy. And that's a good way to measure like kind of the base level of debt, because usually the debt is there to stimulate the economy anyway. That's what we're using the deficit for, right? So the debt to GDP ratio, if you look at it for our country right now, it's been around 100%. 95, 100, 105, depending on the debt level of GDP that you look at. Japan's is like, I forget, It was closing in on 200% at one point. It's well beyond ours, right? Greece was having a lot of debt issues where they had a debt to GDP well above 100%. But a lot of people are kind of thinking it's around that 100% level. That's kind of where you want to like bogey it, where you're kind of getting close to causing problems. At the end of the day for the US, we're in a unique position where our dollar is the global reserve currency. And so much transactions and so much value in those transactions are priced based on dollars. And so many countries around the world want to hold our dollars and our debt that it's probably less of an issue for us than it would be for like the Eurozone, for Greece, for Japan, for Australia, and those kind of places. So I think, a lot of people, they get really worried about it. I'm not too worried about it from a financial apocalypse scenario, but I think you do have to consider that if we have a deficit of 1.9 trillion, that's 1.9 trillion of debt that we have to issue every year to fund that shortfall in tax revenue. And that debt is, that comes out of capital markets. That's a strain on interest rates. That's why we've seen interest rates go up a little bit, but it's also stimulative to the economy. That money is flowing right back in to the economy, which is why I'm pretty confident that we'll continue to have pretty strong growth.
Yeah, certainly. I'm trying to pull this tweet I sent you. I'm scrolling out 1 second.
Send me a tweet.
It was a while ago.
Mid-recording? Oh, okay.
No. I'm not scrolling Twitter while you're talking.
Dang, dude.
All right. Okay.
You, our poor listeners.
It was that each American will pay the $3,593 in interest payments this year on our national debt, and it was taking that 1.2 trillion of the annual interest expense, and then dividing it by per capita, I guess. So like the population.
Yeah, like the population. Yeah.
Yeah. Do you want to talk about that a little bit more?
Sure. I'll weigh in on that. Have you gotten a bill, an invoice for our portion of interest? I've not gotten mine.
IRS didn't hit me up yet.
Okay. So. This is a deficit, right? It's literally what we're spending that we have not been taxed on. So by definition, no, we are not paying for this interest right now. We're literally just rolling over our debt to pay for it. Just like your 12%
What do you mean by that,
AP,
rolling over our debt?
We're refinancing it. So, we have T-bills, 1-year notes, 2-year notes that come to maturity. The Treasury now has to, we have debt and we have an ongoing deficit, right? So not only do we have to replace that debt for the funding, but we also have to secure additional funding on top of it to fund our future spending, right? Okay. So whenever that debt matures, we're not going to default on it. What we're going to do is just issue a new 10-year bond, use those proceeds to pay off the old people that held the 1-year or 2-year bond, whatever matured, and then now we term that out. The problem is that as we do that, our bonds are pricing into higher interest rates, so that interest component's growing, and it's also the interest is being charged on a growing base of debt. And so that's why that interest component, it was like $300 billion not too long ago, just a few years ago, and now it's $892 billion. I mean, it'll be $1 trillion by the end of the year, I think, is what a lot of people, or end of next year is what a lot of people think. So, some of these things you can kind of see, and like, you got to be able to cut through the political rhetoric and understand what politicians are just saying because they're politicians and they want to get elected versus like what practically can happen and what kind of trade-offs we have to start thinking about to actually address some of these problems. And then maybe even another pillar of that is this really a problem, right? Everyone agrees it's not a problem yet. It will be a problem soon, but when, we don't know. Maybe that's so far out that we really don't have to worry about it.
And this is one of my biggest qualms with news media and all these other things is that they always are talking about these scary Armageddon scenarios and want you to watch a lot. And I feel like the last 20 minutes we've been talking about kind of a scary scenario and what that means. And this will eventually potentially be a problem, but we don't know when. It's not one right now. What would you say, Jeff, to like instill confidence in terms of we're still confident and bullish and optimistic in the returns that we're going to see in the U.S. economy, in the stock market? Because that's definitely my opinion. And I'm fairly confident it's yours as well.
Yeah, I mean, I think economic growth still looks really good. Productivity growth has started to accelerate over the last couple of years. This fiscal stimulus is going to be very stimulative for the economy, and that's generally good for stockholders. And I think one other point is that a lot of people hear about the spending, they hear about the Federal Reserve cutting rates, and they worry about inflation. And I think that's a legitimate concern. I think increase in spending, higher deficits when we're at full employment, right? We're in a supply constrained economy and you're adding more demand on top of it. It's logical that would result in inflation, but I would encourage people, if you're worried about inflation, you're worried about the value of the dollar relative to everything else, including consumer goods and services or assets, then you should be buying those assets, right? Because as the dollar becomes less valuable relative to everything else, that means the price of everything else is going up. That's how we understand inflation to happen, right? Prices of goods and services go up. Another way to say that is the dollar has gotten cheap relative to goods and services. Well, that also happens relative to commodities, relative to crypto assets, relative to the valuations of businesses, which is what we invest in stocks. And so if those are things that you're concerned about, or you just see the amount of stimulus that's coming into the economy, you should be wanting to buy assets of all kinds, including all the assets that we invest in our portfolios. One caveat there is that you don't want to get in the way of all this issuance that's coming at the tail end of the yield curve. So we would recommend staying in the short to intermediate part of the yield curve, so that 1 to 6 year part of the yield curve, and not extend out beyond that 7, 10, 20, 30 year duration that could have you locking in interest rates when interest rates could be drifting higher because of all this issuance and this drag in capital market funding.
Certainly. And I know we talked about some of like Republican policies and policies under Trump, and you mentioned inflation there. I know that was a big sticking point for both campaigns, but I know one thing that Trump talked about a lot was tariffs. And this was something that I've actually gotten a lot of questions from people within my circle. I don't know that you have anything prepared or want to speak on that at all in terms of what that means for prices of things. For me, kind of what my understanding, I'm happy to chime in, but I'm sure you have a better understanding of it than I do.
I mean, I think there's like two like segments of thought here with the tariffs. Like, one is that they're totally not taxes. They're fine. They're a great way to raise revenue. Don't worry about it. Don't worry that it's never worked ever in the history. And then the other side is tariffs are just another way of saying tax. They're sales tax. They get passed on to consumers. They're not good for economic activity. They're not good for the efficient allocation of resources. And I'm more in that latter camp, right? And I think that's a consensus economist view, is that tariffs are not only a tax that are paid by consumers. That's absolutely true. But also that they any kind of tax screws up the efficient allocation of resources that capitalism intends. And the reason why we trade with other countries is not because we're trying to ship off our manufacturing to other countries and just steal people's jobs from them. It's because there's some things that we're good at in the U.S. and there's other things that other countries are good at because of the resources and the environment that they're in. And that when we just specialize in what we're good at and then trade with each other, both sides accrue the benefits and the savings from that, and they're actually better off, right? And so what ends up happening is they both increase production in whatever area that they have efficiencies in, and then they trade with each other at lower prices than what the other could do on their own. We can't grow avocados here in the U.S., right? So we have to import them. There's a lot of labor that we use in China that's extremely cheap and that we couldn't replicate at the same cost here in the U.S. And so I think imports or tariffs are generally bad. If the Trump administration uses them as a negotiating tool for fairer trade practices, I'm all for it. But I think he's also recommending things like against Mexico. And during his last administration, they renegotiated NAFTA and created a whole new trade agreement with Mexico that now he's trying to back out of with proposed 100% tariffs, right? So there's other things that he's saying that I think are a little bit out of left field, and that probably you want to look to his advisors for the details of.
Yeah.
And then one more thing I want to say about the election, Arish. I know I'm hogging this episode.
No,
but there's a really cool chart in here. There's a really cool chart that I saved that shows why so many Americans that felt like the economy was not doing well for them over the last few years are about to feel like the economy is going gangbusters. And it's a little chart that shows consumer sentiment based on political affiliation. And what's interesting, this chart goes all the way back to 2000. And you can see, the red line for Republicans or the blue line for Democrats. What you'll see is that Democrats did not assess the economy in the mid 2000s was strong, but Republicans did. And then all of a sudden, Obama was elected. And, both sides understood the recession in 08, 09. And so they both understood that the economy was bad. But as the economy improved after the Great Recession, only Democrats recognized that it improved, and consumer confidence among Republicans stayed really low up until 2016 when Trump was elected, right? And then we see a huge increase in the consumer confidence from Republicans. We see the Democrat consumer confidence kind of flatline a little bit, and then of course they both go south after COVID. And then we see the similar thing happen again after COVID. The economy rebounds. The economy's been doing pretty good over the last few years. We talk about that all the time. Really, only Democrats notice that within their consumer confidence surveys, whereas Republicans still, only 10% of Republicans would rate the economy as excellent or good. I think that is about to change big time. And whether, we can talk about what policies are going to be put in place and what, which side is better for which industry. But, psychology matters. Psychology of people and consumers matter. And so, we'll see if this optimism that Trump created in 2016 and 2017 returns to what appears to be half of Americans that are not seeing the economic health that the data reflects.
Sure. Yeah, no, that's a great point, and glad you brought that up, and we'll make sure to have that on screen. You mentioned an interesting thing when we were talking about tariffs, when you said some things we're good at and some things other countries are good at. My buddy sent me this graph, and it's from Reddit, so grain of salt. This could all just be fake info. So but this is bringing back this. We had that conversation about AI a while ago, but it was comparing the cost of a call center in different countries versus ChatGPT. And so I don't know what this is. Oh, cost per minute in USD. So in the US for a call center, cost per minute for actual people is 30 cents per minute. The UK, 27 cents per minute. ChatGPT 4.0 brings this down to 15 cents, saving a ton. But the Philippines is 6 cents and India is 3 cents. So it's still not there. It's crazy. Yeah. I don't know if you heard about the Amazon to go big scandal on their grocery store.
I guess not. What happened?
I haven't verified this. I've heard it a couple of times. It might be, I guess, fake. But did you hear about their grocery stores that were to go? You don't have any...
It's walk right out, right?
Register, you just walk right out. And they said they have a bunch of cameras and AI technology and all this stuff. Apparently it was just a huge group of people in India who were just watching every little thing that was being pulled.
No
way. It's cheaper to do with where we were at with technology. So
wow,
that's crazy. But
yeah, I mean, that's I think they call it the resource endowment model, right? And it kind of talks about how countries specialize in what they've been endowed with in the resources, right? A lot of countries get oil, commodities, certain things like that. We have a lot of capital intensity within our industry and a lot of human capital, as in our workers tend to be a little more educated, so it can provide higher level services versus, China that has a lot of just, workers that are willing to work at low wages, right? That's not something the U.S. has. And so, but labor is a resource that can be used that way. So I think it's a lot of people look at tariffs as a way to stop imports, because imports are stealing business from America. They should be buying things in America, but they're not. They're buying things overseas. It's just not the way economists think about it.
Sure. Makes sense. Well, I had a quick end of year tax planning thing, unless you had something else you wanted to quickly cover.
I think the only thing I would say is I forget, what was it, 20% tariff across the board is what's suggested. And that's going to replace income taxes. Is that what I heard somebody say? So I was just going to try to find the amount of total imports that we had in 2023. Here it is, 3.8 trillion.
Okay.
3.8 trillion. Okay. So let's see, our total taxes that we bring in is close to 4.8 trillion. So we're going to need an above 100% tariff on all of our imports to generate the same amount of taxes. And that's assuming that the level of imports stays the same, which I think with a over 100% tariff will probably not be the case. So it's just not something that the numbers are supporting here.
Sure. Gotcha. Well, I know we're running a little long. I want to be quick. Mention a quick end of year tax planning thing that I think is really important. I know it's something we talked about end of year last year was really, really relevant in 2022, not as relevant here in 2024 because the market is doing really well and a lot of areas of your portfolio should be doing well. And that's tax loss harvesting. And so what tax loss harvesting is when certain areas of your portfolio aren't doing as well in a given year. You have a diversified portfolio, and one of the main reasons for that is some things are going to go up, some things are going to be flat, some things are going to go down, and we want that for your risk mitigation. But you also have an opportunity in a taxable brokerage account. So not a retirement account, not your 401k, not your IRA, not your Roth IRA, but a brokerage account to sell the things that are down and purchase something similar. And so if you're looking at funds and you only really invest in ETFs or mutual funds, which is primarily what we look to do. If you had a mid-cap allocation and for some reason mid-cap was down in a given year, you could sell it before the end of the year and purchase another fund that's very similar. The only way this would really be applicable, and Jeff, feel free to chime in if you have any other asset classes you think of, but I was just really thinking individual stocks. You have a brokerage account and you have individual stocks. Even in an awesome year like 2024, you're going to have winners and losers. You have that opportunity to sell those quote unquote losers, the ones that are down in this year, and capitalize on that loss. And then either wait 30 days and purchase them back if you want that allocation. You have to wait that 30 days for the wash sale rule. Or you just reallocate that elsewhere. Maybe you put that into a mutual fund or an ETF or the S&P 500, whatever it might be. But I think it's a really interesting strategy, something that we're always doing for our clients. And I think is one of my biggest arguments just on the strict asset management side of a brokerage account, that even if you're doing it yourself and you feel like you're choosing the positions really, really well, doing tax loss harvesting each and every year goes a really long way in minimizing overall tax liability. And I think it's not something that do-it-yourself investors are really thinking about or ever really doing on their own.
That's a great call. Yeah. Individual investors, if you own shares of Moderna or Supermicro or some of these companies, maybe a good chance to tax loss harvest. I think the most important thing about tax loss harvesting, Arish, is that you're realizing a loss and you're booking that loss for tax purposes, but you're reinvesting those proceeds into something similar, which allows you to stay invested, right? Markets go up and down. That's kind of their normal behavior. They mostly go up, but you have to be patient for that. And there's some periods, even over a year or 2 years, where they don't go up and they go down. You never know when that's going to change. You never know when that tide is going to shift. But tax loss harvesting, booking those losses while you have losses, and then maintaining your exposure for when the tide turns is a really nice way to increase your after-tax returns of your portfolio. We do that for our clients. We've been very active. Unfortunately, this year, every position that we buy for clients is up, and it's up a lot. And that's a great position to be in. I think high unrealized gains is the best problem you can have in wealth management. And luckily for us and our clients, we booked a lot of losses in 2022 to offset that.
Certainly. Well, always appreciate picking your brain, Jeff. I'd say the biggest conclusion from today is you can put Christmas lights up whenever you want. So enjoy
Damn
those.
Right.
Enjoy those up. This is probably coming out right around Thanksgiving. So if you're a listener, we're thankful for you. You're far and few between, but we appreciate you guys.
That's right.
I hope we can keep creating good content. But thanks for listening.
Thanks for letting me hog the time today, Art.
Always.
All information provided by this presentation is for educational purposes only and does not constitute investment, legal, or tax advice. It is not an offer to buy or sell any security or any insurance product. This is not an endorsement of any third party or such third party's views. The information contained herein has been obtained from sources we believe to be reliable and is not guaranteed as to its accuracy or completeness. Whenever there are references to third-party content, this information is intended to provide additional perspective and should not be construed as an endorsement of any services, products, guidance, individuals, or points of view outside of Beam Wealth Advisors, DBA Benedetti Gooser and Associates. All examples are hypothetical and for illustrative purposes only.
Beam Wealth Advisors, DBA Benedetti Gooser and Associates does not offer tax or legal advice. Interested parties are strongly encouraged to seek advice from qualified tax and/or legal experts regarding the best options for your particular circumstances.